Hello students, how are you? Today we are going to discuss retirement of partners, right? Retirement of partners from the partnership. Earlier we have discussed how the goodwill is shared and those things. Today we will discuss one question, right? Let us go into the question, please. Okay. A, B, and C are partners sharing profits and loss in the ratio of 2 is to 1 is to 1, right? 2 is to 1 is to 1, right? Respectively, their trial balance as at 31st March 2020 was follows. Buildings 35,000, furniture 20,000, machinery 25,000, cash 10,000, debtors 30,000, and capital A 40,000, B 20,000, C 20,000. Current liabilities, sundry creditors 25,000, outstanding expenses 5,000, general reserve 10,000, altogether 40,000, right? The what you call they want to tell us that the following the above on the above date Mr. C retired from the business. The following are agreed among the partners, right? We will see one by one. Machinery revalued at 23,000. Machinery revalued at 23,000. Machinery is carrying down value is 23,000, right? Then 25,000, 25,000. Then the difference is 2,000. 2,000 goes to the revaluation valuation account because 2,000 is the loss, right? Machinery brought forward value is 25. They says carrying down value is 23,000. Then difference is 2,000. 2,000 is the loss, revaluation loss. So we are going to transfer it to the revaluation account. Revaluation account machinery. Revaluation loss 2,000, right? And machinery account credited 2,000, right? So first adjustment revaluation account debit 2,000, right? And machinery account credited 2,000, right? Because revaluation loss because of revaluation loss. Revaluation account debit 2,000, machinery account credit 2,000. And buildings at 40,000. Buildings 40,000. Carrying down value of the buildings are 40,000, right? So 40,000 in the sense, what is the difference? Brought forward value is how much? 35, right? Then carrying down value is 40,000. Then 5,000 is the revaluation profit. Revaluation profit that has to be transferred to the revaluation account. So buildings is 5,000 revaluation profit, right? Revaluation account, buildings account debit, and revaluation account credit. Account credit, right? How much? 5,000. 5,000. The double entry is finished, right? Because they said brought forward value is 35,000. Okay, building. Carrying down value is 40,000. We have done the opening balance. We have put it into the accounts, right? Earlier, before we are starting the question, right? Then 5,000 the difference is the profit, revaluation profit that has been transferred to the revaluation account credit. Okay. Then B is outstanding expenses 1,000 need to be paid. Outstanding expenses 1,000 need to be paid. Need to be paid. That means outstanding expenses 1000 need to be paid. Outstanding expenses again 1000 we have to add. Outstanding expenses 1000. That is revaluation account. Revaluation account debit, right? Third one. Revaluation account debit 1000 and outstanding expenses credit 1000, right? Because we have revalued the outstanding expenses. So here we have to say outstanding expenses credited and here revaluation account debited. Outstanding expenses. Expenses, right? 1000. Depreciate furniture by 10%. Furniture balance 20,000. Depreciate by 10%. Then 2,000 is depreciation that has to go to the revaluation accounts. Then carried down value is 18,000. Right? Revaluation loss furniture. Furniture 2000. Right? Here we will say for fourth one revaluation account debit account debit 2000 and furniture account credit 2000. Revaluation loss, right? Revaluation loss. And because we have revalued, depreciation is by 10% means for 20,000 10% is 2,000, then carried down value is 18,000. So 2,000 is loss revaluation account debit and furniture account credit 2,000, right? Goodwill of the firm is valued at 20,000. Goodwill of the firm is valued at 20,000. Then goodwill account debit account debit 20,000. Capital account credit A, B and C. 4. A is 10,000, B is 5,000 and C is 5,000. That is the being revalued the goodwill. Goodwill account capital account 20,000. That is goodwill. How much? 10,000, 5,000 and 5,000. Right? Goodwill. That is we have done. Then A should bring 20,000 and B should bring 10,000 as an additional capital to pay the amount due to retiring partner C. A has two, right, cash account. Capital A and B. A has to bring 20 and another one is 10. 20,000 and 10,000. Right? Cash account. 20,000 and 10,000. Right? They had to bring. Right? Make provision for bad debts 5% on debtors. Provision for bad debts. Provision for bad debts 5%. 30,000. Then that is 1,500 is the provision for bad debts, that is revaluation account. Let's say 1500 for revaluation account, provision for bad debts, right? Okay, finished. So provision for bad debts, right? So with that, the necessary journal entries has to be passed. So we have to calculate the what you call the revaluation profit or loss. Here revaluation loss took place, right? 500, right? 6,500, 6,500, 6,500. Capital account A, B, and C. A, B, and C. 1,500 is there. 1,500. 1,500 in the sense 1,500 divided by 4, 375, right? One portion is 375. Then 750, 750 and 375 and 375, right? Then revaluation loss 750, 375 and 375, right? Then we will balance the account, right? Cash balance carried out, right? This is 25,000, here 25,000 and 24,625. 24,000, 24,625, right? 24,000 C, right? 24,625. 24,625, that is capital C, right? So this is 35, this is 60, 70, 70,000, 70,000 and 35,000. Then if you deduct 34,625, 34,625, 34,000, 34,625, right? This is 750 in the sense 69,250, 69,250, 69,250, right? That is the balance. Okay, what is the cash book balance? Carried down? No. Brought forward? Carried down? 40,000, 40,000, then 375, 375, 15,375, 15,375, 15,375, right? That is the cash book balance. Goodwill, 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 that is 20,000, 20,000. Machinery, 23,000, machinery, right? 23,000, machinery. Buildings, 40,000, buildings, 40,000, then 63, 83,000, right? Outstanding expenses, 6,000, carried down, 6,000, brought forward, 6,000, 6,000, then 31,000, okay, 31,000. Furniture is 18,000, furniture 18,000, 18,000, 91, 101,000, 101,000, right? And bad debts provision, 1,500, 1,500, 28,500, 28,000. General reserve, general reserve we haven't transferred, so we had to say general reserve, right? Here we had to alter again everything. We didn't take the general reserve now, so general reserve, reserve, general reserve how much? 10,000, 10,000 divided by 4, 2,500, right? 2,500 means 10,000 general reserve to capital account. Capital account debit 6, capital account debit uh, no not capital account, general reserve reserve account debit 10,000, capital account credit A, B, C, that is 5,000, 2,500 and 2,500, right? You know the general reserve had been transferred, right? General reserve 5,000, 2,500 and 2,500, then total will be 25, 27,550 and 35, 37,500, and this is 75,000, right? So 75,000, 37,500, 27,500. Right? Here 27,125. That is cash. 20,000, 27,125. That is for cash. 27,125. Right? Cash. Balance carried or no? 37,000, 37,125. 37,125. 37,125. Right? 75,000, 74,250. 74,250. 70, 37,125, 74,000, 74,250. Right? This is the balance. Okay. This is 375 and 1, 8, 8 and say 100. Right? Cash balance 40,875 rupees. Right? 28, 12,875. 12,000, 12,875. General reserve also. So if we add this one, 375, 375, 1, 10, 11, 1, 3, 4, 41,000. Then total assets is 75, 142,375. 375, 142,370. Okay, it is balancing. This is the way of doing the retirement partnership. Here in retirement partnership, this is the double entry is very crucial. That is disbursement, not disbursement, creation of goodwill. This is the creation of goodwill. Goodwill account debit and all the partners capital account creditor. That is the goodwill and disbursement of the expenses and everything. This is the balance. Okay. I hope you would have understood the question, and I hope to conclude this session, and I hope to meet you in next session. Thank you.